Welcome to our deep dive into the top long-term value stocks for 2024. Value investing is more than just picking cheap stocks. It's about finding hidden gems that can grow over time. Did you know that over 80% of Warren Buffett's wealth came after he turned 65? That's the power of long-term investing. In this video, we'll uncover some shocking truths. For instance, small-cap stocks often outperform large-cap stocks by 2% annually over the long term. Yet, many investors overlook them. We'll explore why and how you can find these hidden gems yourself. Ever heard of the Dividend Aristocrats? These are companies that have increased their dividends for at least 25 years. Investing in them can yield impressive returns. In fact, they have outperformed the S&P 500 by 1.88% annually over the last decade. We'll also talk about global giants. Did you know that Nestlé operates in over 190 countries? That's almost every country in the world. These companies have the scale and resources to weather economic storms and keep growing. And let's not forget the game changers. Disruptive innovators like Tesla and Amazon started small but revolutionized their industries. Investing in such companies early can be a game changer for your portfolio too. Let's get started. Chapter 1. Hidden Gems, Under the Radar Stocks. Investing in hidden gems is a strategy that focuses on uncovering undervalued stocks that most investors overlook. These stocks often come from smaller companies that haven't yet gained widespread attention. By discovering these hidden gems early, investors can capitalize on significant growth potential. One key to finding hidden gems is to look beyond the headlines. Many investors tend to follow popular trends, but true value investors dig deeper. For example, consider small-cap stocks. These companies often have more room to grow compared to established giants. A classic example of a hidden gem is Netflix in its early days. Before it became a household name, savvy investors saw its potential. According to a study by the Journal of Financial Economics, stocks of lesser-known companies tend to outperform more famous ones over the long term. When searching for hidden gems, focus on strong fundamentals. Look for companies with solid balance sheets, consistent earnings growth, and low debt levels. Warren Buffett once said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This quote underscores the importance of quality in value investing. Industry research is crucial in identifying hidden gems. Sectors like technology, healthcare, and renewable energy often harbor innovative companies with high growth potential. For instance, the renewable energy sector is expected to grow by 8% annually through 2030, according to the International Energy Agency. Another tip is to pay attention to insider buying. When company executives are purchasing shares, it often signals confidence in the company's future. Insider buying increased by 33% in small-cap stocks last year, highlighting potential opportunities. Networking with other investors can also uncover hidden gems. Join investment clubs or online forums where ideas are shared. Sometimes, the best stock tips come from fellow investors who have done their homework. Don't ignore the power of financial ratios. Metrics like the price-to-earnings (P/E) ratio, price-to-book (P/B) ratio, and return on equity (ROE) can reveal undervalued stocks. Benjamin Graham, known as the father of value investing, emphasized the importance of these ratios in his classic book, The Intelligent Investor. Chapter 2. Disruptive Innovators, Changing the Game. Disruptive innovators are companies that revolutionize industries with groundbreaking products or services. Investing in these innovators can lead to substantial long-term gains. Companies like Tesla and Amazon started as disruptors and have grown into market leaders. Identifying disruptive innovators involves looking for companies with unique value propositions. These companies often solve problems in ways that others haven't considered. For example, Tesla's focus on electric vehicles has disrupted the traditional automotive industry. A study by Harvard Business Review found that disruptive companies often start by targeting niche markets before expanding. This strategy allows them to refine their products and build a loyal customer base. Over time, they can scale up and challenge established players. Disruptive innovation is closely tied to technological advancements. Companies that leverage new technologies to create better solutions often lead the charge. The rise of artificial intelligence, AI, is a prime example. AI-driven companies are transforming sectors like healthcare, finance, and logistics. In healthcare, for instance, AI is used for early disease detection and personalized treatment plans. According to PwC, AI could contribute up to $15.7 trillion to the global economy by 2030. Investing in companies at the forefront of AI can be highly rewarding. Disruptive innovators often have visionary leaders. These leaders inspire their teams to think creatively and push boundaries. Steve Jobs' leadership at Apple is a classic example. His vision for user-friendly technology led to the creation of iconic products like the iPhone and iPad. It's important to monitor a company's R&D spending. High investment in research and development often indicates a commitment to innovation. Companies that consistently invest in R&D are more likely to introduce disruptive products. However, investing in disruptors comes with risks. Not all innovative companies succeed. It's crucial to evaluate their business models, competitive advantages, and market potential. Conduct thorough due diligence before making investment decisions. Chapter 3. Dividend Dynamos, Consistent Cash Flow Champions. Investing in dividend stocks is a tried and true strategy for long-term investors. These companies pay out a portion of their profits as dividends, providing a steady income stream. This chapter will explore how to identify dividend dynamos and why they're a solid choice for value investors. First, look for companies with a history of paying and increasing dividends. This shows a commitment to returning value to shareholders. For instance, Johnson & Johnson has raised its dividend for over 50 consecutive years, making it a reliable dividend dynamo. Next, consider the dividend yield. This ratio shows how much a company pays in dividends each year relative to its stock price. A higher yield can be attractive, but it's important to ensure the payout is sustainable. According to a study by Harvard Business School, companies with moderate dividend yields and consistent growth tend to outperform. Pay attention to the payout ratio, which is the percentage of earnings paid out as dividends. A lower payout ratio indicates that a company retains enough earnings to reinvest in growth while still rewarding shareholders. Warren Buffett often emphasizes the importance of a sustainable payout ratio in his annual letters to shareholders. Diversification within dividend stocks is key. Spread your investments across different sectors to mitigate risks. For example, combine healthcare giants like Pfizer with tech leaders like Microsoft, both known for solid dividends. Reinvesting dividends can significantly boost long-term returns. This strategy, known as dividend reinvestment, allows you to buy more shares and compound your gains. A study by the S&P Dow Jones Indices found that reinvested dividends accounted for 33% of total equity returns since 1926. Look for companies with strong free cash flow. This metric indicates how much cash a company generates after accounting for capital expenditures. High free cash flow suggests a company can comfortably pay dividends and invest in future growth. Starbucks, for example, has consistently high free cash flow, supporting its growing dividend payouts. Consider dividend growth rate. Companies that increase their dividends regularly often have strong financial health and growth prospects. The Dividend Aristocrats, a group of S&P 500 companies with at least 25 years of consecutive dividend increases, are prime examples. Economic moats can protect dividend-paying companies from competitors. These moats, such as strong brand identity or patents, help sustain profits and dividends over time. Coca-Cola's powerful brand is a classic example of an economic moat. Chapter 4. Resilient Performers, Weathering Economic Storms. Investing in resilient performers is a strategy focused on finding companies that can thrive in both good times and bad. These companies have proven their ability to withstand economic downturns and emerge stronger. In this chapter, we'll explore how to identify these resilient performers and why they're essential for long-term value investing. Start by looking at a company's track record during past recessions. Companies that maintained or even grew their earnings during economic downturns are likely to be resilient performers. For example, Procter & Gamble continued to perform well during the 2008 financial crisis due to its portfolio of essential consumer goods. Check for a strong balance sheet. Resilient companies typically have low debt levels and high cash reserves, giving them the flexibility to navigate tough times. Apple's massive cash reserves have allowed it to weather economic storms and continue investing in innovation. Consider the diversity of a company's revenue streams. Companies with multiple sources of income are better positioned to handle economic fluctuations. Amazon's diverse revenue, from e-commerce to cloud computing, helps it remain resilient. Look for companies in defensive sectors. Industries like healthcare, utilities, and consumer staples tend to be less affected by economic cycles. During economic downturns, People still need healthcare, electricity, and basic consumer goods, making these sectors more stable. Dividend-paying companies often exhibit resilience. Regular dividend payments signal strong financial health and a commitment to returning value to shareholders. According to a study by Ned Davis Research, dividend-paying stocks have historically outperformed non-dividend payers during market downturns. Economic moats are another key factor. Companies with competitive advantages like brand strength, patents, or network effects are better equipped to fend off competitors and maintain profitability. Microsoft, with its dominant position in software and cloud services, exemplifies a company with a strong economic moat. Examine a company's management team. Strong leadership can navigate challenges and capitalize on opportunities during downturns. Berkshire Hathaway's Warren Buffett and Charlie Munger are renowned for their ability to steer the company through economic turbulence. Chapter 5. Global Giants, International Market Leaders. Investing in global giants offers exposure to companies that dominate their sectors worldwide. These market leaders often have extensive resources, strong brand recognition, and vast customer bases. This chapter will explore how to identify and invest in these international powerhouses for long-term value. Start by looking at companies with significant global market share. Firms that lead their industries across multiple regions tend to have stable and growing revenues. For example, Nestlé, the world's largest food and beverage company, operates in over 190 countries. Consider the benefits of currency diversification. Investing in global giants provides exposure to different currencies, which can help mitigate risks associated with currency fluctuations. According to a report by Vanguard, currency diversification can reduce portfolio volatility. Check for robust supply chains. Global giants often have well-established supply chains that ensure efficiency and cost-effectiveness. Toyota's lean manufacturing system, known as the Toyota Production System, is a model of supply chain excellence. Look at a company's adaptability to local markets. Successful international firms tailor their products and marketing strategies to fit local preferences. McDonald's, for instance, offers region-specific menu items like the McSpicy Paneer in India and the Teriyaki Burger in Japan. Consider the political and economic stability of the regions where these companies operate. Diversifying across stable regions can protect investments from local economic downturns. The Economist Intelligence Unit regularly ranks countries based on political stability, which can guide investment decisions. Focus on companies with strong brand recognition. A powerful brand can drive customer loyalty and premium pricing. Coca-Cola's brand, valued at over $80 billion by Interbrand, is one of the most recognized in the world. Look for firms with technological leadership. Companies that lead in innovation are often better positioned to maintain their market dominance. Samsung's continuous investment in research and development keeps it at the forefront of the electronics industry. Chapter 6. Sustainable Stars, Leading the Green Revolution. Investing in sustainable companies aligns financial goals with ethical values. These companies prioritize environmental, social, and governance (ESG) factors, often leading the way in the green revolution. This chapter will explore strategies to identify and invest in sustainable stars for long-term value. Start by looking for companies with strong ESG ratings. These ratings assess a company's performance on environmental, social, and governance criteria. MSCI ESG ratings provide comprehensive assessments, helping investors identify sustainable leaders. Consider the environmental impact of a company's operations. Firms that reduce their carbon footprint and invest in renewable energy are often more sustainable. According to a report by the International Renewable Energy Agency, IRENA, renewable energy investments could generate up to $10.3 trillion in economic benefits by 2050. Look for companies with transparent sustainability reports. Regular and detailed reporting indicates a commitment to sustainability. The Global Reporting Initiative, GRI, standards are widely used for sustainability reporting, providing transparency and accountability. Evaluate a company's supply chain practices. Sustainable firms ensure their supply chains are ethical and environmentally friendly. Patagonia, for example, is known for its commitment to fair labor practices and environmental sustainability. Consider the social impact of a company's activities. Firms that prioritize employee welfare, community engagement, and diversity often have stronger long-term prospects. According to a study by McKinsey, companies with diverse workforces are 35% more likely to outperform their peers. Look at the governance structure of the company. Strong governance practices, including transparent decision-making and accountability, are hallmarks of sustainable companies. Warren Buffett often emphasizes the importance of good governance in his letters to shareholders.